Welcome to Trading Nation. I'm Brian Sullivan. We're joined today by John Stoltzfus. He is Chief Investment Strategist at Oppenheimer Asset Management. John, I guess some congratulations are in order because the S&P hit your 2017 price target of 24.50. I guess the only issue with that is it's only late June. So do you raise your year-end target or say, okay, maybe the market rally is over, let's trim a little bit of our winners?
Well, at this point, Brian, we're considering what we're going to do about that target. We think there's likely opportunity for us to raise it. The question is how much higher, based on where we are related to economic growth of around 2 to 2.5%. Earnings have been getting stronger, although consensus is looking for a slight weakening in earnings in the second quarter. They recently cut estimates, looking for about 6.6% growth versus the first quarter that came in at around well over 7, around 7.8%. So when we look at it, we just need to consider it a little bit further. If we get any stimulus out of Washington, that might make us more enthusiastic, but we expect to have a new target within next 3 to 5 days.
Okay, so likely going up. Is it primarily earnings, John?
Yep, it is a combination of earnings as well as investors who have been sidelined for years out of the stock market who are beginning to come back. I think as they acknowledge the apparent fact that interest rates are not going to rise exponentially from here based on economic growth, globalization, and advances in technology that are disinflationary rather than inflationary. So what we've got to think is where we stand right here, a combination of earnings, sentiment, and the need for the functionality of equities. Equities have the capability to provide dividends if they're dividend payers, as well as potential for capital appreciation. And with 74 to 78 million Americans in the baby boomer generation, that means to us that people are going to be looking for functionality. When fixed income, what's the 10-year Treasury today at around 2.12%?
So what's the biggest risk then? I mean, obviously, if you're bullish on earnings, the risk, I guess, would be to earnings. A lot of geopolitical stuff going on, but do you view them as really a threat to just how much, ABC or XYZ corporation make?
Yeah, I think it really has to do with how much the companies make. Are prospects good for the corporations? Is the global economy good? And what we can see here, especially for U.S. companies, the dollar is off since the beginning of the year. Whether you look at the Dixie or the DXY index, or you look at the U.S. dollar versus the G10 currencies, it's off against all 10. At least as of the start of this morning, it was off against all 10 G10 currencies and was off against 14 emerging market currencies. So you'd have to think U.S. companies have a competitive edge here that they haven't had in a while. That should be positive for earnings.
Let's say the Fed gets more aggressive. Let's say you get 4 interest rate hikes in the next 12 months, right? And not many people are saying that, but let's say it happens. Then what?
Brian, I think when it comes to that thought is the Fed has certainly shown us, whether it was during the tenure of Ben Bernanke or now Janet Yellen, these two Federal Reserve chairpeople and their teams have been the best Federal Reserve personnel that I can remember in a career that's now 34 years into it. And I've got to say, I don't think they're going to make a mistake. I think they are remarkably good number crunchers, their capability to gather data, and the aggregate experience at the Fed today, with having gone through 2008, through everything that's happened since then, through today, really is the best experienced Fed that I've ever seen. So I think with inflation remaining relatively low, particularly as a result of wage inflation being very much contained because wages are not rising substantially, the Fed may be able to take more time at the process of normalization, which I believe it's rightfully committed to, but it'll raise in a very small increments, and it will be able to space those hikes so that it will not be quite as much of a shock to either the bond market or the stock market. though there is vulnerability in the bond market. Just as rates rise, they're bound to feel some effect.
John, we're going to look forward to seeing your new S&P 500 target. I mean, you hit it probably a little sooner than even the most bullish of those out there thought that you might.
And we put that target in last December, and it was the second highest on the street at that time, Brian.
I'm sure
so
you took some
pleased.
heat for it, but you were right. John, thanks very much.
Thank you.
All right, John Stoltzfus of Oppenheimer Asset Management. I'm Brian Sullivan. Thanks for tuning into Trading Nation. See you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.